how much hidden operational risk are you carrying in your strategic decisions right now? I mean, could a small, seemingly minor change in one cost require a massive, maybe even an impossible jump in sales volume just for you to stay even?
That tension right there, that kind of domino effect, is exactly what we're getting into today.
Exactly. This deep dive is all about cost volume profit, or CVP sensitivity analysis. It's really the most systematic way to manage business uncertainty. We're just here to do algebra. We're here to analyze strategy.
That's the key.
We're looking at the toolkit that the best managers use to turn that core CVP equation, you know, profit equals revenue minus variable costs minus fixed costs, into a living, breathing strategic roadmap.
Right.
Our mission today is to show you the methodical steps to instantly analyze the strategic impact of, well, any combination of changes to your price, your costs, or your profit goals.
That's right. If you're prepping for a budget meeting or you're assessing a capital expenditure, you need this CVP muscle. The real value isn't just calculating a number. It's developing what we call a verification culture. It's the ability to model a change, see the pressure it creates, and then, verify if the required business response is even feasible.
So to ground this, let's use a baseline case. The Jules Corporation. They make high-end baseball gloves.
A simple setup. The gloves sell for $200. The variable cost to make one is $110.
Which leaves that all-important contribution margin of $90 per unit.
Exactly. And their fixed costs are sitting at $63,000.
And their management has set a target profit of $36,000. So the original math shows they need to sell exactly 1,100 units to hit that goal.
And that number, that 1,100, that's our reliable starting line for every single test we're about to run.
Okay, so let's start with a classic strategic decision, an investment that drives up your fixed costs. Imagine Jules Corp is thinking about a major marketing campaign or upgrading their software.
Something that requires a big outlay.
Right. An $18,000 jump in fixed costs, moving them from $63,000 up to $81,000. But they still absolutely need to hit that $36,000 target profit.
Okay, so let's break this down. We're holding the price steady, variable cost is steady, so that $90 contribution margin per unit hasn't changed.
But the total requirement, the fixed cost plus the target profit, that's just gone up by $18,000.
Right.
So we plug these new numbers into our CVP framework. What is the new volume they need to hit to absorb that cost and still deliver the profit?
The new required sales volume is 1,300 units.
Wow. Okay, so that $18,000 increase in fixed costs means they have to find a way to sell an extra 200 units.
Exactly. And the question for management now becomes, is that investment, the marketing campaign, or the software, is it actually going to drive those 200 extra sales? Because if it only drives 150, the investment was a loser. It actually reduced profit.
That's the strategic core of it. And here's where the numbers tell a story that management really has to absorb. That $18,000 didn't just require more units. It required a huge revenue correction.
Absolutely. You have to quantify that pressure. At $200 a glove, those 200 extra units, that's $40,000 in additional required revenue.
So you went from needing $220,000 in sales to needing $260,000.
All this just to stand still on profit.
That is a critical point.
Yeah.
Managers get so focused on the expense column, they can miss the revenue impact. That $40,000 revenue jump is 2.22 times the original $18,000 cost increase.
And that multiplier is your immediate leverage insight. It just screams at you. For every single dollar you add to your fixed costs, you need to generate $2.22 in additional contribution margin.
It just quantifies the risk immediately.
It does. An 18% increase in fixed costs demanded an 18% increase in unit volume, and therefore an 18% increase in revenue, just to maintain the same profit. That visualizes your business's resilience, or maybe lack thereof.
That's a wild leverage. But we know the contribution margin is the absolute core lever in this whole equation. In that last scenario, the $90 CM stayed the same.
Right.
But things get way more sensitive when we start to mess with the CM directly by moving the other variables.
That CM connection is really the foundation of true sensitivity analysis. So let's hold on to that new $81,000 fixed cost baseline, the one that required 1,300 units.
Okay.
And let's look at two forces that act directly on that CM. First up, variable cost.
Let's say materials costs jump a bit, maybe a supply chain issue. It raises the variable cost from $110 to $115. So just a $5 increase per unit.
Right, just $5. It doesn't sound like a catastrophe, does it? Especially not next to an $18,000 fixed cost hike.
No, but because that variable cost directly eats into the CM, our $90 margin instantly shrinks to $85. So
Exactly.
what's the unit requirement now?
Well, the required units jump pretty significantly to 1,376.
Wait, hold on. A $5 increase in variable cost means they now need to sell 76 more units than that massive $18,000 fixed cost jump required.
That's the sensitivity. It's staggering. It's because every single unit you produce is now less profitable. The hole you have to dig out of gets deeper with every sale.
So if a manager has to choose where to focus their energy negotiating down variable costs or cutting some discretionary fixed costs, this analysis basically screams that variable costs are the priority, right?
Precisely. They offer the biggest bang for your buck in terms of risk reduction. You could argue that variable costs are the most sensitive lever in the entire CVP structure.
Okay, so let's compare that vulnerability to the opposite lever, changing the selling price. What if Jules Core can pass on some costs, maybe raise their brand prestige a bit, and they increase the price from $200 to $210?
All right, so a $10 price increase.
Yeah, that's double the cost increase we just looked at. It boosts our new contribution margin from $90 up to $100. So keeping that $81,000 fixed cost baseline, how does that change the volume we need?
The units need to drop, and they drop substantially down to 11,070.
Wow.
And this just highlights how strategically powerful pricing is. In this one case, a 5% price increase almost perfectly offsets the entire $18,000 fixed cost increase. It just dramatically dampens the volume you need to find.
So this is critical information for managers. I mean, when you're facing cost pressures, the easy fix might seem like cutting fixed costs.
It often is.
But the CVP analysis shows that leveraging your pricing power or just aggressively managing your variable inputs, that gives you far better control over your risk profile.
Yeah, absolutely.
And before we move on, there's a really critical practical point for any manager running these numbers, the rounding rule. If your calculator spits out that you need, say, 1,414.29 units to hit your target profit, what do you actually tell the sales team?
You can't sell a fraction of a glove. So since you are solving for a target profit, you must always round up to the next whole unit.
So 1,415 in that case.
Exactly, 1,415. That guarantees you either meet or slightly exceed the profit target. If you fail to round up, you are guaranteeing that you'll come up short. It's a small detail, but it's vital for accuracy.
The beautiful thing about this whole structure is that it scales perfectly, even with complex decisions where, multiple things are moving at once.
You don't have to test one variable at a time. Real life isn't that simple.
No. So let's test a full strategic pivot for Jules Core. They accept the fixed cost jump to 81,000 because they know they have to modernize. They absorb the variable cost increase to 115 because raw material prices are just what they are. But they try to offset all that pressure with a price increase to 210.
So we just update all the parameters. The new contribution margin is 210 minus 115, which is $95.
Right. And the total financial requirement, the fixed cost plus the target profit, is still that 117,000.
So when we run that calculation, the new units needed is 12,232.
And that's a perfect example of a multivariable solution. The company successfully made a trade-off. That $10 price increase more than compensated for the hits they took on both fixed and variable costs. It kept the volume requirement manageable.
And that ability to analyze allows us to look at really crucial strategic trade-offs, like between different cost structures. Let's look at the Erda Rock crushed rock company. They were analyzing a huge automation decision.
A classic high fixed cost, low variable cost trade-off.
Exactly. Initially, Erda Rock had a traditional labor-heavy model. 60,000 in fixed costs and a pretty high variable cost of $4 per ton. They sold rock at $6 a ton.
Leaving them with a thin $2 contribution margin per ton?
Very thin. And to just break even, they had to move 30,000 tons of rock.
So the proposal is to automate the whole crushing process. It would increase stability, but it requires new financing. Their fixed costs would jump pretty significantly to $80,000.
So a $20,000 jump.
Yeah. But the efficiency gains were huge. The variable costs were cut in half, down to just $2 a ton.
Which effectively doubles their contribution margin to $4 per ton.
Now, this is where managers have to go beyond their gut feeling. A lot of managers would balk at a $20,000 increase in fixed costs. They just see risk.
Of course. But if we connect this to the bigger picture, that doubled contribution margin more than compensates. Even with the higher fixed costs, their new break-even point is only 20,000 tons.
Wait, so the automation, which cost 20,000 more in fixed expenses, is a fantastic decision because the efficiency gain drastically reduced their break-even volume by 10,000 tons.
Exactly. It shows that higher fixed costs aren't inherently bad if they generate enough CM leverage. The new cost structure is actually safer. If the company sells 25,000 tons under the old system, they're losing money. Under the new one,
They're already profitable.
they're already profitable. CVP analysis gives you the math to justify moving to a more stable, higher leveraged business model.
And CVP doesn't just evaluate good choices, it's also an early warning system to identify just impossible plans. Let's talk about a disaster scenario for Erda Rock,
Yeah.
kind of perfect storm that hits during a crisis.
Yeah, this really raises the question about feasibility. What if three bad things happen all at once? Price drops 15% down to 510.
Ouch.
Variable costs go up 20% to 480 due to inflation, and fixed costs increase 10% to 66,000 from utility hikes.
That initial $2 contribution margin just plummets. It goes all the way down to 30 cents a ton.
Just 30 cents. And that tiny CM now has to cover 66,000 in fixed costs, plus let's say a moderate target profit of 35,000.
The math just screams disaster.
It does. To hit that $35,000 profit, they suddenly need to sell 336,667 tons.
That's almost 500,000 tons. The original feasible target was 67,500. That 336,000 number means the plan isn't just bad, it's functionally impossible.
It is. The analysis shows you immediately that this combination of changes has fundamentally broken the business model. No amount of marketing can compensate for a contribution margin that small. This is why sensitivity analysis is a manager's best friend. It flags these things before you commit.
So after running all these systematic, verified calculations, what does this CVP toolkit let a manager do tomorrow in the real world?
Well, first, it allows for definitive cost-benefit analysis.
Right. The manager can now determine precisely if that $18,000 marketing campaign will actually generate the 200 extra sales they need. If the marketing team says they can only promise 150.
The plan is dead on arrival, and the manager knows it instantly.
And that information is crucial for planning.
For resilience, absolutely. Second, it gives you a robust framework for economic downturn planning. You can quantify the specific profit drop from a market contraction. If sales drop 15% next quarter, the manager doesn't have to guess.
They can calculate that profit will drop from 36,000 to 18,450.
Exactly. And that lets them set contingency targets and mitigation strategies before the crisis even hits.
That certainty, that systematic approach, is the ultimate value here. We're not just calculating one number, we're building a strategic model.
And to reinforce that, the ultimate CVP toolkit really relies on a methodical 7-step structure we've used this whole time. First, identify your current parameters.
Know your numbers.
Second, determine the proposed changes. Third, set up the CVP equation. Fourth, solve for the unknown, which is usually the volume you need.
Okay.
Fifth, and this is critical, verify the calculation. Sixth, assess the business feasibility. Is 1,300 units achievable? And finally, seventh, make the informed, defensible, strategic decision.
And that framework is so powerful.
It even allows for a quick calculation of profit change without running the whole thing. Just remember that net income change equals the change in total contribution margin minus the change in fixed costs. It's a great shortcut.
So we've gone from basic unit calculations to complex multivariable changes, and we've assessed major strategic trade-offs like automation,
Right.
all using the exact same underlying CVP structure.
Right.
I think the true power here of CVP sensitivity analysis, it isn't about calculating one single break-even point. It's using the analysis to actually compare alternatives and understand how resilient your business model really is. We saw it so clearly with Jules Core. An 18% increase in fixed costs required an 18% increase in units and revenue just to maintain the same profit level. That is a very tight rope to walk.
It is.
So next time you hear a company announce a price drop to increase volume, or they're touting some massive investment in automation, just take a step back and ask yourself this. Does the resulting increase in volume truly compensate for the necessary reduction in their contribution margin, or are they falling into the same trap as Erda Rock's disastrous 30-cent CM scenario?
That's the key question.
That calculation is the difference between a viable strategy and functional impossibility, and CVP analysis helps you answer that question immediately.